Hi, my name is Chris Laurie and I'm the Senior Portfolio Manager here at Fiera Capital for the Tactical Bond product. Here at Fiera Capital we manage about $2 billion for this particular product. I work closely with my associate here, Derek Brown. What I'd first like to talk about is our long-only or traditional bond product and the process we go through to manage that, which will also apply to the other products we do. Let's first go over the investment summary of how we do this product. It's a very active top-down product, the way to look at the bond market. Bond markets do trend, and we want to be correctly positioned in this trend, but we can be contrarian at times, both at the beginning or end of a trend. Style-wise, we do make, in this long-only product, large duration calls, plus or minus 3 years. We do have very conservative credit exposure, even though we can have 45% corporates. And short-term trading, which is a little bit different, adds significant value. Our objective, to add at least 100 basis points a year. Let's look at an overview of the process. What we first like to do is identify the key factors that the bond market is focusing on. We want to determine our outlook for these factors. And what makes us a bit different is we compare our outlook to what's already discounted in the market. Trend analysis is constantly employed, and then we can construct a portfolio. Interest rate anticipation and yield curve positioning are first looked at. Sector allocation, or the amount of corporates or provincials we're going to have, are next done. Then security selection within these sectors. Once the portfolio is constructed, short-term trading will be actively done once the portfolio is constructed. Okay, the first step we look at, identify the key factors. At any one time, the bond market is reacting to 2 or 3 key macroeconomic factors, such as economic growth, inflation, or monetary policy. We try to identify these factors and the relationships between them because they do determine the direction of bond prices. Second step is determine our outlook for these factors. Once the factors have been identified, we want to determine our outlook for these factors. Do we think economic growth is improving? Do we think inflation is going to be a problem down the line? What is monetary policy going to be like? The outlook is determined by in-house and external economic analysis and by discussions with the Asset Mix Committee, the fixed income teams, including our credit analyst. Step 3, we want to compare our outlook to what's already discounted in the markets. It's all well and good to identify and analyze these key factors, but we must also see what's already discounted in the market. There is limited return potential if our anticipations are shared by the market and the consensus are already discounted in market prices. If we think the economy will slow and we're bullish on bonds, but everyone else shares that same view, then there's limited potential return. There's much higher potential returns if our views differ from that of the market. We use qualitative tools such as valuations, sentiment surveys, forecast data, and also qualitative tools. We have ongoing discussions with market participations. Derek and I do all our own trading, so we're constantly talking with traders, salespeople, and other internal and external portfolio managers. Let's talk a little bit about trend analysis. Bond markets do trend for extended periods of time. Not only interest rate, but yield curve shifts and credit spreads increase or decrease. We want to identify these trends and correctly position ourselves within the trends. We never want to fight a trend. Our strategy can be contrarian at the beginning or end of a trend. At the beginning of a trend, few are positioned correctly. Near the end of the trend, a lot of people are piling into that trend, and hopefully we are moving out of that trend. Portfolio construction. First thing we want to do is interest rate anticipation. Again, we have an active duration management, plus or minus 3 years. Our long-term duration call is based on a 3 to 12 month time horizon. Yield curve positioning is what we want to do next. Yield curve positioning is based on our opinion of the future shape of the yield curve. And the biggest thing for that is the analysis of monetary policy. Sector allocation. Are we going to be 100% government of Canada bonds, or are we going to have higher yielding provincial and corporate bonds? It's really a top-down call based on fundamental analysis and historical spread analysis. We like to look at key credit factors. For our sector credit factors, we look at things such as business cycle, competition, or changes in the regulatory environment. Issue credit factors could be such things as balance sheet strength, cash flow, or issue covenants. We next want to look at security selection. We have a very conservative approach. Our philosophy is one of risk avoidance, and our guiding principle is term magnifies credit risk. We only take very conservative positions in the long end of the bond market, utilities and infrastructure, which are recession resistant and have positive cash flows, consistent cash flows. In the mid part of the curve, we will look at the big banks and insurance companies, and only in the short end of the bond market will we look at things that might be a little less liquid, asset-backed securities, or some cyclical bonds. Things that if things go rough, we can retire them, or they're much easier to sell. Our emphasis is on quality liquid issues. We add value by overweighting sectors at the correct time or underweighting. We're not about picking individual securities, looking for a BBB bond that we think might become single A. That's not what we do. And all our securities are approved by our credit team. Because of this, we've had no losses or due to bankruptcies or credit deterioration in the last 25 years. I'm going to talk a little bit about short-term trading, and these are short to medium-term trades, anywhere from 1 day to up to 3 months. And they are based mostly on short-term technical analysis, things like daily sentiment index, trend lines, LA wave oscillators, and occasionally on fundamental information. We have a policy of strong risk management. These trades are only done with benchmark Government of Canada bonds, and we use stop losses systematically. Whenever we put on a trade, if the upside target is $2 or $3, there'll be a strict stop loss at something like $1. If we're knocked out of the trade, we'll regroup and try it again. Expected sources of added value. We make most of our money through interest rate anticipation. 2/3 of our money comes that way. Long-term duration positioning counts for 30%. The short-term trading counts for 35%. Yield curve adds about 20%, and sector and credit adds about 15%. These are long-term averages in any 1 year. Any one of these can be higher or lower, but this is how we see long-term averages. Hi, I'd like to now turn it over to Derek Brown, who's going to talk about some of our other alternative strategies. The idea with these other alternative strategies is we wanted to have a benchmark that has 0 years duration, so we can actually have negative duration or positive duration depending if we think interest rates are going up.
Hi, I'm Derek Brown, Associate Portfolio Manager here at Fiera Capital Corporation. As Chris mentioned before, I'll be talking today about some of the alternative strategies we have just launched here at Fiera Capital. Over the past 30 years, the bond market has been in a bull market. Rates have fallen from about 16% in the US 10-year down to 2% currently today. However, if you look back further in history, from 1950 to 1981, interest rates were only rising. From 1981, however, all the way till today, they have been declining, which leaves us with the question, what will happen next? We do think going forward that interest rates will increase over the upcoming years. However, we don't think we'll get back to those 16% levels for quite a while or even maybe ever. But we do think there is definitely inherent risk in owning a fixed income portfolio going forward. A brief example of this is that we believe that coupons no longer pay investors for owning the risk in a bond portfolio. A quick example again would be back in 1990, the Canadian 10-year bond had a coupon of about 10.5%. Therefore, on a 100 basis point increase in interest rates, you would still make a positive return of about 4.5%. If the same scenario were to unfold in 2012, the coupon is only 2.25% on the current 10-year in Canada. Therefore, 100 basis point increase in yields would see investors lose about 6.5% on their bond portfolio. That is why here at Fiera we decided to design an absolute return fixed income portfolio. We can take duration positive, down to neutral or zero duration, effectively eliminating all interest rate risk from the portfolio, or even take it to negative and therefore profit from rising yields or falling bond prices. So what does this portfolio look like that's able to have a positive return in all interest rate cycles? Well, essentially, 90% of the money is in a traditional fixed income portfolio, and we carve out a 10% remainder to use as a duration overlay for the entire portfolio. So essentially what we're doing is turning duration on and off, or interest rate risk on and off, depending on how we see the market unfolding. Now, all decisions made in this portfolio are based off the same investment process that Chris explained to you before. This portfolio itself is investment grade only, and therefore no high yield bonds into it. The conservative credit allocation is, again, the exact same as Chris mentioned before, the one that's had no bankruptcies or severe credit deteriorations over 25 years. The vast bulk of the portfolio would be A-rated or above. We have an allocation of about 50% in corporate bonds, 30% in provincial bonds, and the remaining in federal agency bonds. The duration, again, benchmark duration of this is a zero duration. Therefore, the neutral home base of this portfolio has no interest rate risk in the portfolio. Well, what is this 10% that's able to manage duration for the entire portfolio? Well, the simple answer is essentially exchange-traded futures contracts. We use Canadian and US bond futures contracts to hedge out the interest rate risk and to take active positions in the portfolio. We take our Canadian 90% portfolio, or the core portfolio, and we hedge that out using Canadian futures contracts. Now, if we were to take a negative duration position, therefore to profit from falling bond prices, we would go to the United States and use their futures contracts. The reason behind that is essentially the volume and the depth of the market in the United States. Whereas the Canadian bond futures market trades about $60 billion per month, the US trades about $2.5 trillion per month. And therefore, it's quite significant when we need to trade on a relatively active or quick basis. So we use Canadian and US bond futures contracts to take active and hedge positions. So what we would do is we would take our 90% core portfolio and hedge that out with Canadian bond futures contracts. Now, a quick example would be if we had about $1 million in the core portfolio, it would take approximately about 7 contracts in Canada to hedge out that portfolio. And what that would do is that take our core portfolio duration of roughly about 7 years, and that would move us down to 0. So at any point in time, if we wanted to get long duration, we would simply unwind our hedge. Now, once we're at 0, if we decide we actually want to profit from falling bond prices or rising yields, we would then take a negative duration position, generally by going to the United States. Over the long term, the goal for this portfolio is an absolute return, net return to the client of around 6 to 7% per annum. This includes a 5% distribution paid out quarterly as well. Over the long term, we expect the returns to come from roughly about 45% from interest rate anticipation, 30% from short-term trading, about 5% from yield curve, 0 to 5% from yield curve, and roughly about 15 to 20% from corporate bond returns. As Chris mentioned before, what's extremely important in any type of active strategy is a very strong and systematic risk management system. In this fund, we have 2 different levels of stop losses. One on an individual position basis, so each stop loss is predetermined before we enter the position. And we also have a total fund stop loss, which at any point in time of the month, whether it be the 1st, 2nd, or 31st of the month, if that stop loss is hit, the fund is completely hedged out and we wait till the following month before trading again. So in summary, just to go over the key points of the fund, this fund really is a duration management tool to help diversify the risks in a fixed income portfolio going forward. The duration bands can go either positive, neutral, meaning 0 duration, or to negative to profit from rising yields. In addition, this is an absolute return strategy. Therefore, regardless of falling, rising, or flat yield markets, we hope to achieve roughly a net return to the client of about 6 to 7%. In addition to that, our correlations, which we've achieved since inception, are very close to 0. That includes all bond markets, all equity markets, and even treasury bills. And this is the goal going forward, and it's extremely important for us that we really present this as a diversification tool for clients and their fixed income portfolios. I'd like to thank you for taking the time to listen to the Tactical Bond Yield Fund presentation, and I'd like to pass it back to Chris now for some closing remarks.
On behalf of the Tactical Fixed Income team and Fiera Capital, thank you very much for watching.